Hello, good weekend, everybody. Welcome to this silver log, and it is the 9th of April, 2011. As of the recording of this video, we'll go over some of the action within silver, mainly some volatility. But before we get into this weekend's charts, I want to go over a few comments that were posted on Wednesday's blog, three of them in particular. The first one, Eric states, and the first paragraph was copy and pasted from my market sentiment. Because of all of this, the $78, $120 targets coming are in the near sight, and the long term view stays buy no matter what. And I'm saying that because I changed the intermediate term time frame from that of buy to sell slash hold. Now, the reason for this is because we're moving towards the upper end of the range, which is between 31 and 48 on the intermediate term. Thus, when you get to the higher ends, you really don't want to be buying near peaks. You want to be buying on dips or after some sort of market correction. Now, as far as the long term is concerned, I'm using the same sort of theory. Let's just do a quick example of a chart. If this is your price objective, and this is where we are, and you're expecting it to go higher, then you want to buy during the lower part of it. This is where you want to buy. And in here, you'd rather just buy on the dips because this is where you're playing towards. And within this level, if this is the breakout before of the 30 level, this is the 48 level. Well, here we are now at 41, so we're pretty much getting past the halfway point, which is why I changed the intermediate term sentiment. Now, as far as the long term, this upward band is quite high. Thus, the middle would be definitely 78 below, as of course the areas where you want to get the best prices possible for the silver. Now, my personal belief is that it's going to go well past this $78 mark, or at least when you price it into real assets, continuously gaining on so many of them. The second question, what a rally. Any thoughts on when SpotMex will open? 2 months, 6 months, or longer? If you're not familiar with what SpotMex is, spotmex.com is a new site about to open run by Stella Concepts, who is on YouTube. And this is a place for people to buy and sell silver and gold on the open market. When will it open? I'm thinking it should be soon. I'm not too sure. I'm not involved within it, but I do look forward to seeing the launch of the site. And the final comment from Erica. Thanks for your easy to understand explanations. I just learned about precious metals a month ago after reading Mike Maloney's book, and that's an amazing book, by the way. I'm totally convinced, but as a newbie, I'm also totally overwhelmed by all the charts, trends, timing info. I finally bought my first 500 ounces yesterday, and I've been hyper ventilating ever since. I have about 200,000 more I could spend. I also have about 30K in an IRA I could buy silver with. Could you offer some words of guidance and encouragement for someone like me? Should I just buy now and not worry about the dips, or hold to see if there's a correction? If you have any recommendations on the nuts and bolts of buying, what dealer, bar, and coins are going in the mix, home or vault storage, I'd really appreciate it. Oh, I forgot to mention I'm purchasing for the long term, cannot stomach all the ups and downs. Well, it's going to be tough within this ups and downs battle because silver is extremely volatile. It's up there as one of the more volatile moving charts. Gold nowhere near as volatile, but I like silver mainly based on its fundamentals. And if you're already got in, you've got 500 ounces, you're doing fine. I really don't want to say much more other than to make my ideas and everybody else that you come across your own. All right, now let's move on to the charts. Now, the first chart that I'm going to be going over is the direction from the 50-day low and the 50-day high. How this is calculated, at least on the lower end perspective, is it takes its current price that it's trading at, and it finds the amount it is up from the lowest point from 50 days ago. Therefore, the lowest point we had 50 days ago currently at around $41 an ounce. We are about 37%, 38% above that level. As far as the 50-day high is concerned, the way that one would be calculated is you take the 50-day high level, subtract it from its current level, and divide it again by its current level. That's how much it is off from it. And the charts normally wouldn't look like this. So this is such an easy chart to view because it's really not messed up. You can see the blue trend, which is from the high, really well. You can see the orange trend really well. Normally it chops back and forth and very difficult to read. But when your primary trend is staying in one direction, it makes it easier. The primary trend is obviously towards the upside. As far as using this trend for a buying situation to find entry points, what I have noticed that works well is for this for an image, excuse me, for a chart to come lower and then break a key level of resistance, sort of like in here, sort of like in here. And when you break that key resistance, that can oftentimes give you nice buying opportunities. Now, as far as buying opportunities with the blue chart, which would mainly be for shorting, there really hasn't been too many because it was unable to make a move in here, it was unable to make one in here, and it's really never been more than 10%. But what I find interesting about this current setup is when we compare what happens here to here, it had a nice little move where it would stay 30% above its lows for a few months, and it's really just been starting that now. Now, not always a market's going to look exactly like it did before, but it's definitely a reason to state that the market is definitely not up too much. As of right now, it could still continue to go higher when we look at the moves that it made from last year. Now we're going to move on to the short term, the hourly chart for the silver, and it's been obviously very bullish this last little week. The uptrend is very much intact. Let me just draw another parallel line. That didn't work too well. Let me do it again. Alrighty there. Here we go. So therefore, this parallel line worked out to be resistance. It found support. It got above it. Now the range is pretty tight, so that's very common for stuff like this to happen where you break it on many occasions. However, with that being said, the market is well above this rising 5-day moving average, which is very bullish and still really overextended. That doesn't mean that it can't continue to go higher, but it's likely that it's going to consolidate in some way before it's going to continue to go up, whether it be through time like we've seen in here, or whether it be through price, which is something like we see in here as forms of corrections. Now, as far as these Fibonacci levels are concerned, what I posted on my blog after the market closed on Friday was that it seems as if this 39.33 level is just a little. It worked out too nice for my liking as a projected 76.4% level. Earlier on in the week, I stated that I'd like to see this line match up over here. Thus, right now we can see that it's getting fairly close, which means it's getting close to the 41.40 target. Question is how significant is the resistance roughly around here? And it's not as significant as it is in here. So this gives me concern for thinking that the market will top at 41, and rather, if this area here happens to be the 61.8%, which is this line in here, meaning it's going to move up here because of higher gains, it would have to get to $43.40 an ounce. And that would make sense for a more significant target, but it's still very difficult to say that as of yet. As I was saying on the Friday morning video, for me, the best way to determine any type of intermediate top is going to be a surge in that of the volatility. This is the volatility chart I've been using for the last couple of weeks. I've had a few people or a couple people ask how this chart is made. It's very simple. You take the within an open, high, low, closed data, you take the highest point or the high, subtract the low, divide it by the low. That's the percentage gain from top to bottom. And then within this chart here, to make it easier to read more than anything, I have a 30 period average and I add the 120 period average of this and I multiply it by whatever number to give it a nice number. So I multiply it by 1,000. You can multiply it by 50. You don't even have to multiply it by anything. You could use a 50 period, a 200 period. You could use a 20, a 60, and a 150. It wouldn't matter too much, but it does give you a good idea towards the volatility. Now, at the end of the day, the volatility did start to rise a little bit, but this has been happening quite often during this downtrend of the volatility. Also, because of this, we have seen that we've barely seen any 1% gains. As far as over 1%, we haven't had a move over 1% since here. You have one in here, here, many here, a tremendous amount in here. So we're not having the gains that we used to have from before. Therefore, until we start to see this thing start to spike higher, this index start to move back at least over a dozen, then this is going to continue the market to either move sideways or to move higher. And another note too is if we do start to see how this market starts to have, say, some massive volatility, something in this area in here, what I would watch out for is the potential for the start of the increase of the volatility to be to the upside. Say, for example, during this period in here, the volatility gets really big. Well, for the first part of it, this might be bullish volatility, and then it might go to bearish, meaning once you start to see gains that are really fast, where we see 1.5% in 1 hour, where you see $1 gains in an hour, these are the types of moves and positions where I'd be starting to be a little concerned for a blow off top. But until that's the case, I'm going to still be expecting the pattern to at least stay sideways or move higher. This chart here is the 15-minute line chart, and I haven't really brought this up too much with the whack of moving averages. I'm not going to really go over them. But I think what's important for this is this trend line and the price action. Now the trend line I started calculating really back around here because it connected this resistance point really well, and it stayed intact for quite some time. When the market had its real only correction during this run, at least significant one in here, it went away from this trend line. It has been well above it for a decent amount of time, but it's getting closer and closer to making a hit towards this level. Right now we're at the point where if we can have a nice 20% move, we'd be there. But what I find very interesting is if we take the length of this bull market, I didn't want to get out of black because we see so much of it. What color works best? Blue? We'll do gray. Okay, so if we take the peak from where it went from its lowest point to its highest point, we can see that it's done maybe 60% of a duration between this rally and the other one. Also, if we draw a peak from the short term or from the top to the bottom, match it up towards here, then we're really getting close to where this market went to a very volatile moment because we're in low volatility now, as was the market low volatile until here. Then the volatility really picked up right in here. As I was stating before you have a down move, the high volatility might make a high move happen first and then a possible down move. Now, as far as the longer term is concerned, this is using daily data for volatility. This is the same calculation as is used on the hourly. You take the high for the day, subtract the low, divide it again from the low, and then you take these averages, and this is what we get. And what we see here is a downtrend and a sideways consolidation. So stage 4, stage 1, as far as how trends work. If you're looking to trade something like the chart on the lower end, which you really can't, then you really need to have a break above this level. And then that can change the trend from neutral to high volatility. So thus, since the markets settled down, the volatility has been lighter. We'll take a look at the weekly data momentarily to show that it's still not that light. But in comparison to where we are, it is. Because the volatility with the bigger numbers came from the 2008 market fall. When we take a look at the size of these levels, we really only had one decent sized move, which was the October November push that see the market fall, I think, from 29 to 25. Most of the time, high volatility will bring down moves within the market. But overall, as far as this is concerned, volatility since March of 2009 or the last 2 years has pretty much been around the same. The next chart we're going to look at is the weekly chart. Weekly candlestick chart. Obvious, that's just too big of a line, especially if you're watching this on full screen. I don't know how many people watch these videos on full screen. I think it's designed for the smaller images or the little iPads, but regardless of the fact, the market within this logarithmic chart, the previous trend line that we found support on during this rally is being acted as a level of resistance. Breaking above this, wow, it's going to be extremely bullish as far as some other trend lines are concerned. This one in here would be your significant support level. Looking at this on a candle by candle level, at least for the recent time frame. After these two candles in here, the small doji ones, the red and the blue ones in here, these are consolidations or time corrections, which has had three candles up the second last week. This one in here was more of a consolidating or a corrective candle. So I would expect either the market to correct in some form next week or for one final positive up week candle. Got to watch out though for major volatility that can come within this market. Finally, the final chart here is the weekly chart. Same thing as the last two, same calculations, taking the high to the low periods. And when we see what we have here is that the volatility was massive from this point on to this point. This goes to Stardust back in the March top, I guess. This is where the volatility peaked. Notice how this goes up when the market went up to 21. This is what happened. When the market hit this point, the market was going from 16, 15, even $14 an ounce up to 21. And then the major volatility, this is massive. When you can keep this running for as long as you are in here, that's out of control. When we're talking about a COMEX default, at the crash of JP Morgan, the currency death for that matter, I can guarantee you without a shadow of a doubt that it will not come on low volatility when the currency is that of resting in peace. But for now, we have not seen a move over 20% since in here. The last 20% moves here, 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 and here. So there hasn't been one in roughly 2 years. To me, this almost shows indecision. It's very similar to that. Nobody wants to do any big moves that's either going to crash this market or explode this market towards the upside. And when I'm looking at a move from $17 an ounce from last August up to $42 today, 41, that's a gain of about 140%. And that to me is not explosive. Not when we had moves in 1979. I've seen the markets go up 700% in a year. And not only that, but there's been many volatile moves along the time frame. I had one person comment stating that it's just up too much. And in order to know if something's up too much, you need to have something to compare it to or something to define it definitely. I'm just going to finish this off and state, in order to know that it's up too much, you need definite proof or definite evidence. And if that's the case, back in 1979, if you thought the market was up too much then, you should have been selling on the way up at around $13 per ounce, or even 12, but it went up to 50. At the same point, you should have bought at $25 an ounce after it topped, because the market went from $1.25 in 1972 to $50 in 1980, and then back down to $4. That's wild volatility to say the least. And another future update, I'll even go longer term by showing the monthly data, not today, and then that will compare it to what was happening back in the 1970s. Thank you for watching this. What do we got for time? 20 minutes. Well, take care and have yourself a great day. Bye bye.